Hi there, welcome to Nepi Invest and welcome to another article reaction video. This could be seen as a companion piece or companion article reaction to another article reaction video I did on Livewire, 6 investing mistakes to avoid and improve your returns. In fact, whole reason I did a reaction video to that particular video is because I read this article first from Motley Fool titled The 3 Rules New ASX Share Investors Should Always Follow, written by James Micklebrough. So I read this one first, then I read this Livewire article, and I thought, let's do an article reaction on both articles. Okay, now this particular article seems to be aimed or directed to new ASX share investors. I would call myself a seasoned investor, but even these sort of rules could be applicable to seasoned investors like me. So I'm going to go through these 3 rules, talk about whether I agree with these 3 rules and whether I follow these rules or how good these rules are, and well, I thought of what I think of them and whether or not I have followed these rules in the past and where I've broken these rules in the past, which may be more relevant, and whether I've learned from breaking those rules in the past. Okay, so let's start with the first one, which is think long term. Okay, so definitely when I first started investing, I thought I was thinking long term, but then I came to a realization that I wasn't thinking as long term as what I should be. And I actually did give a really good example in that previous reaction on 6 investing mistakes to avoid. A really good example about JB Hi-Fi, where I bought it in 2012 or something like that. Then I sold it not long after when the share price had doubled. And I wasn't really thinking long term. I was just thinking, well, I've made some profit, should sell. And the share price has gone up maybe 6-fold since then. And so that was not me thinking long term. In fact, back then when I was investing, I was never thinking that long ahead. Wasn't thinking 5, 10 years ahead, even 20 years ahead. I was just thinking, well, I'm up, might as well take profit. So I wasn't really thinking long term. So this is a major shift I have done in the past 5 to 10 years. I am thinking way more long term now, and I have think this has been very beneficial for my portfolio and my wealth generating. So the other very important thing here is understanding your strategies and your plans. So I have developed strategies, and I have 2 main strategies: buy high quality companies to hold for the long term, and then a trading strategy, which is more of a short term thing, short to medium term thing. So when it comes to long term, I just want to find high quality companies and own those high quality companies for as long as possible. And I'm not talking about years here. So he mentions years in the commentary of this particular part. So I'm thinking decades. I'm thinking 10 years, 20 years, maybe even 30 years ahead. And these are sort of companies I want to own for that time period, because over 10, 20, or 30 years, compounding is way more powerful. He does mention compounding here. He also mentions dividend. I don't agree with dividends. So the reason I don't agree with dividends here, so he mentioned staying invested for years, not weeks or months, allows compounding dividends to do the heavy lifting. Dividends has a little role, but it's nowhere near as important as the growth of the company itself. If you compare CSL to, say, Telstra over the last 25 years, have a look at the returns of those 2 companies over that point in time. There's a gulf between CSL and Telstra. I've done a video on this, and the gulf isn't because of dividends; it's because of the growth of the company. So I'm looking for growth, and dividends is just a nice little added benefit. In fact, I very rarely look at dividends when it comes to my long-term investments. In fact, I would say I actually ignore dividends when it comes to my long-term investments. In fact, I would also say that, in my opinion, dividends suppress innovation and growth, and I'm looking for companies who can innovate and growth. So dividends are actually counter to what I'm looking for long-term investments. He also mentions here, time in the market beats time in the market. I actually did have a think about this. I was going to actually have a counter to this, saying I don't absolutely agree with it. But when it comes to my long-term investments, actually this is true. When it comes to my long-term investments, I don't care about timing exactly. In fact, the definition of a high quality company, if you just have a look at a chart, is the share price should go up through time. Maybe not consistently, but over time it should go up, which means just having a position in that company over the long term is going to be better than just trying to time your buying and selling of that individual company. So even though I was going to disagree with this for the longer term or for my long-term positions, yes, absolutely agree with it. When it comes to my trading, no, this is actually completely different. In fact, timing the market is the most important thing. Definitely more important than timing the market when it comes to my trading strategy, not to my long-term strategy. Okay, rule number 2, diversify, don't speculate. Okay. Uh, so I do speculate on occasion. I do, even now I do speculate. It's I'm trying to get rid of speculation because on occasion, a good speculation would be, for instance, share price of a company drops 50%. I think the market is overreacting, so I'm going to take a position in that company. For me, that is speculating. That's sort of trying to guess what the market is going to do. You could say most of what we do is trying to guess, but it's really interesting that he's mentioned diversify and don't speculate. I think these can be separate, but you could combine these two. And I had a good story about a colleague at work who said, and I think I've mentioned this in the previous video, article reaction video, had a colleague at work who just said that investing, you're putting your money in the stock market is gambling because he had a friend who lost all his money. Obviously, this guy was speculating on one position, one company, and that company went bankrupt. So that goes to diversifying and also don't speculate. Just don't put your money into story stocks. You could put maybe a few bit of your money into story stocks, but maybe not most of your money. Anyway, so let's have a look at his commentary here. It's easy to get caught up in hype, especially with so many stocks floating around online. But true wealth creation comes from owning a range of quality businesses across sectors, not putting all your eggs in one basket. Yeah, I'm not 100% agreeing with this. Maybe for new investors, I don't mind this for new investors, but for me personally, if I have a look at my high quality basket, I don't have a range of sectors because there are some sectors, for instance, mining. I don't think any mining company is high quality. So based off that, I am not following this rule because I am not diversified across sectors. For instance, a lot of investors own Woolworths because it's defensive and you have to be diversified. For me, Woolworths, nice company, but not the sort of growth I'm looking for in my long-term portfolio. I want companies that are growing at a greater rate than Woolworths. So Woolworths will never be in my high-quality portfolio. That's just me. And so there's sort of companies like that I would have not in my high-quality portfolio. I would not define those companies as quality. So I think it all depends on your investing strategies, your plans, your definition of high quality, that sort of thing. And you don't have to be that diversified. You don't have to be that diversified. I'm highly or heavily invested in tech companies because they're more likely to be the ones that are growing over time and take advantage of AI. Okay, so I do agree with not putting all your eggs in one basket. Absolutely agree with that because you can go absolutely broke doing that. But on the flip side, if you do put all your eggs in one basket, you can become ultra rich. That's why there are some investors out there who are ultra rich because they will put all their money into the one stock and that stock did really well. But in an alternate universe, they became broke in 99 out of the alternate universes. Anyway, diversification can help smooth out your returns and protect you from unexpected downturns. Yeah. But you're also more likely, particularly if you're investing in the bigger companies, if you're overly diversified, you're going to smooth out returns to the point where you're just going to get average returns. And I've had some people say to me, you have too many holdings. You have way too many holdings. You should only have 20 to 25. The rule of 20 to 25 holdings is on the assumption that you're only investing in the bigger companies. So a lot of my holdings are in small companies, and you're not really that diversified when you're owning smaller companies, if that makes sense. A beginner way to do this is by using exchange traded funds. I would also say that if you're a new investor, I think going into ETFs and learning about individual companies that are within these ETFs is probably a really good thing. When I first started investing, I don't think there were many ETFs around, but I do think this could be a good way, a really good way to learn more about individual company investing. Okay. If you're picking individual stocks, aim to gradually build a portfolio across industries. Think healthcare, technology, consumer staples, and infrastructure. No, see, I don't agree with that. I don't think you have to be that diversified across sectors or industries. Like for infrastructure, for instance, infrastructure, well, definitely mining, I think is more of a trading sector for me. So for me, healthcare and technology, yes. Consumer staples, meh. Anyway, so that's my thoughts. So I'm a little bit different when it comes to this rule. Rule number 3, invest regularly, not emotionally. One of the smartest habits you can form is investing a set amount at regular intervals, known as dollar cost averaging. I don't do this at all. I don't do dollar cost averaging. I do have money on the side, so I'm not ever 100% invested because there's always opportunities. And I don't say I need to put this amount of money into the stock market every single week or every single month. I think this might work for new investors, for passive investors, but for someone like me, it all depends. It depends on the state of the market, on opportunities, that sort of thing. So I suppose in a way for new investors, this could work. This could work. But yeah, for me, no, this is not relevant at all. Anyway, so investing regularly, it removes emotion from the process and ensures you're not waiting on the perfect time to buy, which rarely exists. I disagree with that. No, there's definitely perfect times to buy, but you're not going to perfectly time. You're not going to perfectly time the market, but there's always a perfect time to buy. Anyway, in hindsight, I suppose. Consistent investing, even with small amounts, can help significantly over time. I actually would say, yeah, this is a really good thing to do. Again, if you're passive, if you don't want to spend too much time learning, that sort of thing. So yeah, I don't mind this rule, but for me, it's not relevant at all. The key is to make investing part of your routine. Well, again, just like paying a bill. Well, again, investing is part of my routine every single day. So I don't have to worry about this. That's probably a good way to look at it. Okay, and that's it. Should you invest $1,000 in CSL right now? I would have said yes. Okay. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, have a look out for my reaction to 6 investing mistakes to avoid and improve your returns. I'll probably release this video after that one, so probably should have already released that one. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.